Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for the segment, we have Genoot, CEO of Hut 8 Corp, Erin Friez, COO of Digital Asset Research, and Taras Kulyk, CEO of SunnySide Digital. They join me to discuss what the Bitcoin halving means for investors, traders, and the broader digital asset ecosystem. It is great to have all of you with us. Welcome to Trade Talks. Let's quickly go around the horn here. Asher, we'll start with you. Nasdaq listed Hut 8 Corp. Explain to us where you sit within the digital asset ecosystem.
So we're a large energy infrastructure company that has a Bitcoin mining practice and a traditional data center practice. So Bitcoin mining, we have self-mining, co-location and hosting and managed services. And then as a part of our data center division, we have 5 traditional data centers that do co-location and hosting. And then we also have an H100 AI cluster on the way as well.
Right. And Erin, tell us about Digital Asset Research.
Sure. DAR is a provider of crypto data and diligence to institutions. We work with both institutions that are crypto native and also traditional financial institutions providing market data. We price over 10,000 crypto assets, reference data, on-chain data, yield data, and indexes.
Right. And Taras, SunnySide Digital.
Thanks, Jill. SunnySide Digital is a services and solutions provider to the data center space. Historically, we've been working with primarily digital mining data centers, but we're now moving into HPC. We do secondary market procurement, sell down of infrastructure, computer hardware, parts, services, EPC, basically anything a data center may have an issue with, they can call us and we can generally solve it.
All right, let's talk about the Bitcoin halving for a moment here, Taras. It's almost like the eclipse that that's what we've all been hearing about. It sounds like this is Bitcoin's moment when you think about the halving. But give us some of the background. What's so unique about it?
It's unique because it's actually built into the code. When you hear about this term, digital scarcity or a hard currency, that's really what it means. Nobody can really change it at this point, given how the consensus mechanism works on the Bitcoin protocol. And really what investors and long-term holders can rely on is that there will only ever be 20 million Bitcoin, and actually a lot less given the amount of folks that have lost their coins into the lake in a boating accident. So really it allows confidence and certainty as to how Bitcoin is truly an anti-inflationary monetary policy for the world.
Right. And Erin, why is the Bitcoin having a significant event for the Bitcoin blockchain?
Yeah, so a lot of things. So, when we take a step back, Bitcoin is a proof of work consensus mechanism, right? So the miners are working to solve a problem. The miners are then rewarded with Bitcoin. That's the only way that new Bitcoin is created and entered into the market is through this mechanism. There will every 4 years or every 210,000 blocks, which is around every 4 years, the reward that these miners receive is then cut in half. This is the 4th halving that we've had. So as of this halving, which will we think happen around the 20th, maybe a little bit before or after, the reward will be 3.125 Bitcoin for every block that is added onto the blockchain. This is important because, like Taras was saying, this really is part of the scarcity that is built into the Bitcoin protocol. There's a lot of demand for Bitcoin. Obviously, we've seen the price rally here over the last couple of months. We've seen new all-time highs. And when you have scarcity and a demand, the price will go up. And we've seen that play out over the last 3 halvings. So over the last 3 halvings, we have seen the price of Bitcoin start to rally generally between 1 to 3 months after the halving occurs. That rally continues. What we've seen in the past is between 12 and 18 months is when Bitcoin hits its peak before it starts to retract. And we've seen that play out over the last 3. I think there's a lot of different conditions right now in the market that could, we'll see if the same pattern plays out, but that's what we've seen play out so far over the last 3 halvings that we've seen.
So, Asher, how's a publicly traded miner like Hut 8 Corp positioning itself for the halving? I mean, how does that impact the model, considering miners, a big part of their revenue stream or the rewards that they get by mining the Bitcoin? How does that impact the model? How are you preparing for it?
So as we think about the mining ecosystem, so we started preparing at the end of 2022. We announced the merger with Hut 8 Mining Corp in the beginning of 23. And the kind of thesis behind it was US Bitcoin was a large-scale private miner that focused on scale and efficiency. Hut 8 was a large public miner that had a large balance sheet, over 9,000 Bitcoin on the balance sheet, and access to the capital markets. Didn't have the strongest operations, and we didn't have the strongest balance sheet in terms of Bitcoin on the stack. So bringing those two together, now we had a large business that had operations, that had balance sheet, access to the capital markets, and can go into the halving with a strong balance sheet, with a strong focus on fundamental operations, but also ideally an opportunity to acquire and build and continue to invest through the cycles. I think when we look at the opportunities, we always kind of plan for the worst and hope for the best. And what I mean by that is we look at hash prices in kind of a worst case scenario and say, how are we going to operate in that scenario and continue to be profitable and continue to run the business? And then if hash prices rise and Bitcoin prices rise, then we're able to have a much better return and yield on the investments that we make. And so for us, a part of that is how do we drive down our cost structure on a marginal basis of mining a Bitcoin? How do we manage the energy markets and a lot of the volatile energy markets that we operate in, which is ideal because you could curtail to drive down costs, unlike more fixed tariff rates. And then on the other side, we also have a diversified business, right? I mentioned one subset of our business is self-mining, which is 68% of the revenue of the last earnings that we released. But now we have, within the same kind of context of exposure of the mining space, we have co-location and hosting and managed services. And then outside of that, we have non-connected revenue streams like our HPC business on the data center side, co-location and cloud, and then on kind of the HPC AI side, GPU as a service as well.
Right. Erin and Taras, I see you guys shaking your heads behind the scene here. So Erin, let me ask you first, do you think the mining industry is well positioned to make it through the halving? How do you see the landscape evolving?
Yeah, so like I said, typically what we've seen over the last 3 halvings is that Bitcoin will start to rally. Again, less, more scarcity, that certainty of scarcity that this halving sort of introduces into the market, and more demand. I think it will be interesting because there's a lot of different factors at play here in the market that we haven't seen before in a Bitcoin halving, and so it will be interesting to see how this plays out. Number one, we're at an all-time high. We have never entered a Bitcoin halving where we've seen a price rally happen before the halving starts. We always see that start to happen 1 to 3 months after. Right now, we're seeing Bitcoin all-time highs. So this is just a new, it's a new event, and we'll have to see how that plays out. On the other hand, though, we are seeing a lot of institutions that are in the space in a way that they haven't been before. With the US Bitcoin ETFs, we've seen a lot of demand. We're seeing inflows into those ETFs of over 200 million daily. That sort of demand is certainly what's driving the Bitcoin price rally right now. So it would be interesting to see if that continues to play out. I think there's going to be, we're watching the UK, which is should introduce Bitcoin ETNs soon as well. Similar regulated wrappers in Hong Kong that are getting ready to pass. So I think we're going to continue to see that demand for Bitcoin play out, which again we should see the same price rally play out in the market. But we'll see. This is certainly a different set of market circumstances than we've ever had before.
It certainly is a trust. When you think about the Bitcoin space post halving, you expect to see a surge in M&A activity in 2024 and 2025. Where do you see that taking place and why?
Yeah, I mean, this really started about 1.5 years ago, where you saw unfortunately, a lot of blood on the street. You had some of the insolvency that were very public, BlockFi, Celsius. Unfortunately, my former employer, Core Scientific, which is now in a much better position. But a lot of pain that you were mentioning before has actually been felt in a lot and has been really absorbed by balance sheets and capital markets. And as Asher pointed out before, a lot of the bigger players are actually very well capitalized, have been pulling ATMs into the market, and now have the capital to continue to expand, but also acquire. And really, as we go through the industry cycle, we're now at a point where scale matters, efficiency matters, EBITDA, free cash flow matters suddenly. So you're not just looking at nonstop growth for the sake of growth, but really looking for financial metrics that traditional investors can get behind. So I think there's going to be continued consolidation, as what happened with USBTC and Hut 8. I think a lot of smaller private players, and even some of the smaller public folks, will certainly see either white knights or stalking horses coming around. But even on the services side, I mean, the larger players that we work with have come to us and said, hey, listen, we really need you to start scaling up. So you may want to start considering it. So that's something that even on the services and solutions side that supports the larger data center operators, you will see some consolidation in this space. Just because, as I mentioned before, scale matters. And that's really the name of the game, to drive down costs to actually increase free cash flow for the space.
Yeah, it's so interesting this is my second halving that I've covered, and just to see the way that the fundamentals have evolved, how the thinking about market infrastructure and regulatory issues has evolved. It's really like night and day. Certainly more akin to other asset classes than we've seen in the past. And of course, like other asset classes, like other sectors and industries, Asher, you can't escape the AI conversation. How is having and heavy compute technologies like AI impacting hardware and infrastructure?
Yeah, so I think I'll kind of segment that question to a couple of different buckets. So the first is how we think about kind of the AI opportunity versus Bitcoin mining. As we look at the business, we see kind of the core and the foundational side of the business is infrastructure. So we have infrastructure. Some of that infrastructure is great for Bitcoin mining because Bitcoin mining likes cheap power. Usually that's stranded power that no one else wants, thus it's cheap. When that power increases in price, it's no longer cheap, and therefore Bitcoin mining could go elsewhere. And so as we build facilities, as we look at opportunities, we look at the ability and the lifetime of those facilities and what the value of those facilities can be over time as different use cases evolve. An evolving use case is AI load because it no longer has the same latency requirements as you have with traditional data centers where it had to be within a certain latency and certain parameter of a city, where now you can go a bit beyond. You still can't go to every single Bitcoin mining facility, but there's some overlap starting to happen now. And it's a really different return profile when we see the opportunity. I think there's some folks within our space that have said, hey, we love this opportunity. We're going to kind of slow down on the Bitcoin mining side and double down into AI. We think about it a little bit differently, where underlying infrastructure is the value, and we see different use cases of maximizing that energy infrastructure. And so we see ourselves of how big of a company could we be if we were just the largest Bitcoin miner, and how big of a company could we be if we were an energy infrastructure company connecting new age technologies to the underlying energy and still having a very large presence in being a top competitor within the Bitcoin mining sector, being a bigger company than that. And the impacts that the AI demand and data centers has going into Taras's world is the demand, the transformers that power the energy, the switch gears, all of that infrastructure, that just the copper to support it is the same regardless of if you're building a Bitcoin mining data center and if you're building an AI center. So there's continual demand and competition for those assets. And then obviously the data centers themselves are vastly different. You're looking at call it $300,000 a megawatt to build versus 8 to 10 million, but it's the same underlying source materials that are creating this massive amount of competition and a supply strain there on the infrastructure side of things.
Right. And Asher, if you could follow on, Taras, if you could follow on to Asher's comments there. And then I also want to ask you, what about responding to the Biden administration's, disproportionate focus on digital mining?
Yeah, I mean, just to follow on with Asher, right now you've got a lot of folks hunting for the same heavy infrastructure. Our team's been extremely busy on transformers, containerized data centers, switchgear, interconnect equipment. So all of that heavy electrical infrastructure isn't just for digital mining. The traditional HPC center builders are actually coming into the space for that infrastructure, because as you look at how AI silicon has been developing, you're getting a higher power density than you've ever seen before. NVIDIA just announced one of their highest density GPUs in the market to date, and that's only going to drive their type of infrastructure needs closer and closer to what Asher and team have been building for years now. So that type of convergence just makes it a hotter market for infrastructure that we have to deal with to make sure that the right equipment gets to the right folks. When it comes to the 30% threat by the administration currently, it's just a long string of saber rattling in a way. From the White House, unfortunately. What we've been seeing is that real jobs are being created in communities that really have been overlooked by a lot of different sectors that are being supported. A good friend, Will Foxley, just put out a very interesting video online that shows the impact that Galaxy Digital had in their small town of Helios, Texas, and how supportive that community is because of the high quality jobs that data centers actually create in these type of communities. So I don't know if Joe wants to be going into an election cycle telling people in those communities that, no, those jobs aren't real. You don't need to really think about them for the long term. That's really not the positioning that the Democratic Party wants to have these days.
Yeah, let's get your thoughts on the regulatory side of the house here, Erin.
Yeah, so I mean, I think when it comes to Bitcoin, obviously there's been some more regulatory clarity, which is great. I think we were, how that translates to the rest of the digital asset space. I think we're all still waiting to see. Will there be an ETH ETF on the heels of this? I think when it comes to Bitcoin in particular, when we think about the halving, we think about mining, and sort of the stance there. There's a really big focus on the environmental impact and what that means, and I think sometimes that's why it's picked up by political parties. I think one of the things that gets overlooked is that the environmental impact of Bitcoin is incredibly measurable. There are things you can do about that. There are ways to to counteract that. I think that's often overlooked. And at DAR we have a whole ESG framework around digital assets, and I think that's a really overlooked topic that is really important to consider here.
Right. And Asher, if you could follow up on that.
Yeah, adding to that a little bit as well is when you look back a couple of years ago, let's actually start with kind of the first rally of Bitcoin mining at scale, more institutional in 2017. People talked about the impact it had on energy, but then when you fast forward to 2021, you start seeing real projects being built with energy, and it was a lot of kind of theory of what could happen. If you look at the photo behind me, I mean, we have a site located at a wind farm, and now it's no longer theory. We can show with data that this was a node that was heavily congested, that had a lot of negative pricing, that the generators had to shut down because there was so much congestion at that node. By bringing that load to this node, we've been able to bring up the average price of the node, allow the generation facilities, not just the one we're connected to, but the ones around, to be able to have higher uptime because there's more positive pricing. And so we're seeing the impact that these loads have on places with more congested power, more stranded power, with the dynamics that we see that a lot of renewables creating. And especially when prices go up, we shut down the facilities because it's not economical for us to stay online. And so we're able to balance that out as well. And so for us, I think when we now have these arguments around, is this helpful for the grid or not? Yes, of course. If you go locate a large Bitcoin mining facility in the center of a city and consume all the power, it's not good. But if you look at the larger scale operators that need low cost power, you are incentivized to go where the cost of power is cheaper, and that's these energy environments and these grids where power is concentrated and congested. And we've seen what the impact of bringing that load there has done, and ideally can continue to drive more development of renewables in a more economically driven fashion rather than just through kind of subsidies and tariffs.
All right, and Taras, final thoughts here.
Yeah, I mean, you had a huge uproar in the summer when Riot Platforms announced that it had a $30 million cash flow windfall from the grid. And people seem to forget that that wasn't just free money. That was actually money the grid paid for willingly because of the amount of money they're saving on the maintenance and upkeep they actually have to have for the infrastructure based on the demand response program that Riot is actually participating in. So net digital mining and HPC could potentially be a net positive for ongoing grid maintenance and stability for everybody. And actually that'll drop the price for everybody.
All right. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.